Howdy, friends. Welcome back to another episode of the Fort Worth Property Management Podcast. I am your host, Mason Arispe. This is episode 11 of the podcast, and it's going to be part 2 of our investing strategy series. Our investment strategy series is meant to show you all the different ways that you can invest in real estate aside from being your traditional landlord. Today, we're going to be jumping into one of the most popular forms of investment strategies. It's clipped all over TikTok. You've seen it on YouTube, and you probably watch it pretty regularly on HGTV. So today we're going to be jumping into fix and flips. We're going to be talking pros, cons, when to do it, when not to do it, who should be doing it, the entire process, and then we're even going to jump into the numbers so that when you're ready to jump into fix and flips, you have the exact formula that's needed to calculate whether or not you have a good deal. With that being said, we are excited to jump into this week's episode. Let's get right to it. All right, welcome back to episode 11 of the Fort Worth Property Management Podcast. I am your host, Mason Arispe. I am the Operations and Business Development Manager here at First Choice Property Management in Fort Worth, Texas. I'm super excited for part 2 of our investment strategy series. We're going to be talking fix and flips. Now, obviously, if you have watched any of real estate TikTok or if you spent enough time on HGTV, you have seen the process of fix and flips condensed into either a 30-minute episode or a quick TikTok clip. And it never fails. They always have a big green number sign with all of their profits that they made at the very end, right? It's awesome to see real estate investing on TV, on TikTok, and it's a very great way to get a lot of people interested in real estate investing. But in the real world, it's not that simple. Fix and flips can be one of the fastest ways to make money in real estate, but they're also one of the fastest ways to lose money if you don't understand exactly what you're doing, if you don't understand the numbers, the process, and the risks. So it's very important that you're aware of all of that so you can plan correctly. And even with that plan, you got to have some room to be able to handle those unexpected twists and turns whenever they come. Today, we're going to break down as much as we can. We're going to talk through how to find deals, how to run numbers, how the financing works, renovations, and timelines. We're going to talk through it all so that when you're ready to jump into it, you can dive in head first, not overanalyze any deals, and you know that you're going to get the job done. So this is part 2 of our investment strategy series. This one is all about fix and flips. Now, before we jump into the main topic of today, we're going to hit a quick segment called Behind Closed Doors. This is your inside look at everything happening here at First Choice Property Management and the Fort Worth rental market. So right now, First Choice Property Management is managing 538 rental properties across Fort Worth and Tarrant County. This is up from the previous podcast. We have had a jump in doors that we've been managing. Property management, it typically does this. It just constantly goes up and down with door count. And so as we lead into the summer, we like to see that door count increasing. Here at First Choice, we're ramping up to prepare for summertime. We have actively stopped tinkering with processes and procedures, and now everything that we worked for during the winter and spring, now we're going to put into play for summertime. It is currently the end of April right now as we're filming this. May typically gets pretty busy, and then after graduation season, the real estate floodgates open. So everybody is out of school in June and July. That's whenever people are moving. It goes for both the sales and the rental market. And so right after graduation finishes, you typically get a lot of real estate activity. And so we are ramping up for that. And we're super excited to get a lot of these new houses that we're bringing on occupied with good renters. The average days on market for Fort Worth right now is 36 days. This is decreased dramatically from the 40s and 50s just a few months ago. First Choice Property Management's average days on market is currently at 25. So we're about a week to a week and a half quicker than the market right now. And here at First Choice, we do have a quality standard for the properties that we bring on. And so we typically see 2 different types of homes, and it's based around the year built. So if it was built after the year 2000, a lot of times it's already pretty modern. It's in a condition that people already like. They have to have updates on paint colors and maybe countertops, and update here and there, but they're modern and they're built for what tenants are looking for nowadays to rent. If you were built before 2000 and even before 1980, the properties almost need a full rehab just based on the last time that they've been really updated. And so whenever we onboard a property like that, a lot of times the homeowner purchased it right after a huge renovation. Somebody purchased it, fixed it all up, and then put it back on the market and sold it. And we absolutely accept those properties into our book of business because they have been modernized, they look great, everything in it's been updated, everything's brand new, and you shouldn't have to put a lot of work into it after a good remodel has been done. And I say good remodel, we'll touch on this later, but a good remodel, not just, we call it putting lipstick on a pig. That's just putting a fresh coat of paint, getting it cleaned, and then putting it on the market. I'm talking a good remodel where everything was redone, everything is solid, everything is new, and it's not going to cost you a lot of money down the road because it was done by a bad fix and flipper, right? And so those homes that have not been updated, they typically sit a little bit longer. If they're older, if they're out of style, it usually takes a little bit longer to find a renter who's willing to live in that home. So we really like those ones that have been updated, kind of remodeled and brought up to market standards, and are exactly what tenants are looking for in a property that they want to move into. And so that kind of brings us to our main concept in fix and flips. So I've said this a few times now. Some of y'all, this term might be just going right over your head. So let's define what exactly a fix and flip is. Real estate investors who get into fix and flips, they take the term buy low and sell high quite literally, because whenever you're doing a fix and flip, you are buying a property as cheap as you can get it, and you're usually looking for distressed properties, rundown properties, houses that have never been updated in the 40 years that it's been built, and you want to buy it for super cheap, okay? And so you're buying very, very low, and then you're going to flip it. So that means improving the condition, redoing everything in the house, almost gutting it down to the studs and improving it. So you're remodeling it. You're putting in new cabinets, new flooring, new paint, new bathrooms and showers and vanities. You're improving it completely and then selling high. You are selling it for a profit. So in essence, you buy a house for super cheap because of the condition that it's in. You put in the work to actually remodel it and bring it up to what current market standards are, and then you sell it for a profit after all of that has been done. Now, of course, everything has to align for you to actually sell for the profit that you're chasing after. Now, obviously, if this is done quickly and correctly, then it's a great way to make a lot of money quick. You turn around, sell it for a profit, and you cash in immediately. But there are so many different variables associated with this process to where something can go wrong. Even as simple as the renovation taking way too long, even that can eat into your costs. So it's important for us to lay all of that out so you know exactly what you're getting into when you're purchasing one of these properties. Now, the adage of buy low, sell high, it's one of the most simplest, easiest way to sum up fix and flips, but in reality, there's a lot that goes into it, because fix and flips is making sure that you buy the right property and get a deal on it. It's making sure that you coordinate the renovation strategically. So you've got to be hands-on watching over this renovation project. It's managing the timeline, because the longer it takes, the more money it costs. It's controlling your rehab costs, because you got to make this place as nice as possible while staying within budget. And then at the very end, you got to be able to execute the sale properly. So you got to get the deal done. You got to get the job done. Ultimately, all parts of that process can make or break a deal. So if you buy a property right at the beginning and you don't get a deal on it, you don't buy it cheap enough, the rest of the process can be thrown off. Or if you run into a problem during the renovation, it's going to cost you $10,000 more than expected. That's eating directly into your profit. Or if you find a realtor who can't sell the house, there's no profit coming in until you get it done. So you can see where every step of that process you can run into something. So we want to talk about everything, and then we want to give you advice on how exactly to be successful when doing this. Okay, so let's go into the first section of that, and that's finding the right property. Where are you going to find these deals at? Do you just go on Zillow? Do you just look online? Is it Craigslist, or where do you find them, right? So finding the right property is where deals are won or lost. If you don't get a deal on the house that you're purchasing, then the rest of the numbers are going to be thrown off. So you don't make the money whenever you sell. Technically, of course, that's when the money hits, but you truly make the money when you buy. That is what will determine how much profit you're able to get at the very end. So if you overpay right off the bat, it's extremely difficult to recover from that. So it's very important that you don't overpay. If anything, you underpay. You get as low as a deal as you can. And so here's a few places where you can begin looking for these types of deals. The MLS, you can sometimes find good deals on there. So the MLS is the multiple listing service where realtors list properties for sale. This is good because you already know that the seller's willing to sell. You just have to have an agent who is able to negotiate a good deal for you as well. So the MLS will send properties to Zillow.com, Realtor.com, like all those major places that you would begin looking for houses. This is an okay place to find a deal because you do have a person who's willing to sell, but they're not the number one go-to to find the absolute best deal out there. Usually if you go to Zillow or the MLS, you're looking for your standard house that's already been renovated or is newer built. You can also find them through wholesalers. So wholesalers are people who specifically look for distressed houses that need a lot of work, and they get them under contract, and they will sell that contract to you for a fee. There's no problem with working with wholesalers as long as they know what they're doing and they are looking out for you as well. So keep in mind, if you get a great deal on this property and that already includes a wholesaler fee, then by all means work with them. Everybody gets a cut of the pie, right? So wholesalers will specifically find the exact style of property that you're looking for. A home that is run down, needs a lot of work, and where there's potential for profit. However, wholesalers will already have negotiated the deal for you. So they have the contract, the seller's already signed and committed to selling, but you got to make sure that the numbers that the wholesaler ran are still good, because you're no longer negotiating with the seller anymore. They've already made that deal and you want to make sure that your numbers are right. You can find off-market deals from friends, relatives, coworkers, anybody who has a house that hasn't been updated in forever. You can tell them, hey, I'm a real estate investor. I'll buy it from you, and work out a deal yourself. You can also be driving down the street, see a house that's just abandoned, run down, and reach out to the owner directly. You can find them online and reach out directly and try and do a deal yourself. You can also find them at foreclosures and auctions. And so there's a few areas that you can find good deals for these properties. It's the MLS, wholesalers, off-market deals from coworkers, friends, family, and then foreclosures and auctions. Those are the best places to find a property that fits your criteria with the goal of fixing it up and flipping it. Now, once you start looking in those few different avenues, you're going to see a lot of different types of properties. As you begin to look in these places, as you begin to analyze each deal, the first thing that I want you to do is categorize the property in one of three different levels of fix and flip. Okay? So the first is a major renovation. This is going to be stripping it down to the studs, possibly doing foundation work. When I say stripping it down to the studs, I mean taking off drywall, ripping out the kitchen, ripping out the showers, the vanities, and it looks like it's just the frame, and you have to redo everything. These are going to be your most intensive, longest, and most expensive renovations. So that is a major remodel. That's when you see a house that's been abandoned for 20 years, nothing is salvageable. I want you to put it in that category. Okay. The next category is a light rehab. With this one, it's one tier down from the major renovation. You don't have to gut the entire thing, but you do still have some renovations on places like kitchens, bathrooms, and then your standard cosmetic stuff. So this is going to be your medium tier style of renovation. And then the lowest tier here is the cosmetic flips. So these are going to be the ones that you just need a coat of paint. You probably want to update some of the ceiling fans and light fixtures to make it nice. And then you might have to redo some of the carpet and the flooring. Just purely cosmetic stuff to bring it up to market standards, get it more modern for what people are looking for now, and then put it back on the market immediately. So you can see the 3 tiers. The cosmetic flips, they're going to be the cheapest, the quickest turns, but you're just doing cosmetic items. The light rehab that you're doing, it includes the items from the cosmetic flip, but now we have kitchens, bathroom remodels, and then maybe a system here or there, like a new AC, maybe a new roof, stuff like that. And then the full gut renovations, I'm talking everything is needed. Structural work, a roof, an AC, you need foundation work, and then you have to do everything inside as well. And that is the most major one. And after you analyze a few different houses, categorizing each of these will be a little bit easier. You'll see the middle tier is the most common. The light rehab is the most common to find in fix and flips. The cosmetic flips, you'll typically get a little less of a deal because there's not major renovations that needed. And then the full gut renovations, the major remodels, you'll typically get the best deal on because solely of the fact that it's going to take so much work to get that thing running again. And so the deeper the renovation, the higher the risk and the more work that it's going to take. Just keep that in mind, okay? So categorizing is great because you can easily weed out the ones that you want or don't want. But you can't solely rely on your judgment for that. You have to break down the numbers. This is the most important part of the entire deal. If you get the numbers wrong, nothing else matters. If the number is wrong, nothing else matters. We're going to go through the standard equation of calculating a fix and flip. So we're going to define a few of the terms first, and then we're going to go through the equation. So the first term that I want to define is ARV. It's the after repair value. This is what the property is going to be worth after it's fully renovated. So what can you confidently sell this property for after it's fully renovated? The first number that you need, because this is what you're going to use as your anchor. That is what you are planning on selling the house for. That directly impacts the rest of the equation that you have. So after repair value, or the ARV, is what you can sell this property for after it's completely renovated. It is extremely important that you know how to run comps, or you have a realtor who knows the area like the back of their hand and can give you a confident number that you can sell this house for. I don't want you to do a lofty, way over market goal because it's unrealistic. We need a realistic number that you can successfully sell the house for. That's usually another house down the street that's the exact same size that has sold within the last year, or even in the last 90 days if you can. You need to know that number, the after repair value. The next term we want to define is the purchase price. This is the number that you are purchasing the property for. Basically, your bottom number, the very cheap number that you are getting this house under contract for and purchasing the property. And then your total investment. All of your expenses, your costs, everything is bundled up into this term, the total investment. Okay, so what's included in that? Your total investment will include repair costs, so like what the renovation is going to cost, your holding costs, so if you took out a loan, your monthly payment, utilities are also a holding cost that people forget about. All of that starts to add up into your profit. And then the cost to sell, all of your realtor commissions and closing costs, all of that is included in your total investment. Okay, so we have ARV, after repair value, the purchase price, and then your total investment, okay? Now, when analyzing a deal, you're going to want to calculate what the purchase price should be. So fix and flippers, they refer to this as your max allowable offer, your maximum allowable offer, the maximum price that you're allowed to purchase this property at for it still to make sense. Obviously, you want to get the deal under contract for a lot less than that number. The maximum allowable offer allows you to calculate very quickly whether or not the purchase price that they're asking for is a good deal or not. And so the standard rule of thumb with the fix and flip community, it's called the 70% rule. So what you're going to do is you're going to take your ARV, you're going to multiply that by 0.70, 70%. You're going to take that, and then you're going to subtract out the renovation costs, whatever your budget is for the rehab. This is a very quick way to determine on average what your max allowable offer should be. So when you multiply by the 70%, the other 30% is there to account for the items like your total investment and your profit. And so that's kind of looped in there. It's meant to be a very quick way to be able to calculate what the purchase price should be. And so if you want to break it down even further, you can break down your total investment, your profit that you want to make, subtract all of that from the ARV. You should be able to calculate your purchase price based on that. But the 70% rule, it is a very great calculation to use so that you can analyze deals quickly, send the bad deals right out the door, and then dig in further to the ones that appear to be a good deal. So based on that equation, you can see that repairs are left out of that percentage. Calculating repairs is a very important part of this overall fix and flip process. You need to either have a good contractor who can get you a quote quick, or you need to have some type of experience in quoting projects like this, so you know exactly how much to expect a renovation is going to cost on each property. Now, before we get into the renovation process and holding costs and stuff like that, I want to talk quickly about financing a fix and flip. So how exactly you're going to pay for it. And so let's talk about the money. There's a few different ways to fund a flip. If you have the cash, that is the simplest. If you have a nest egg that you've been sitting on waiting to invest and you purchase the property outright with cash, that is the easiest. I don't want to say the lowest risk, but you have the least amount of holding costs because you purchased the property outright. From there, you have insurance and taxes that are going to start accruing. And so that is the simplest way to purchase. But most investors either don't have the cash or they just want to use leverage. So that typically is used in two different ways. One is private money. So you have somebody lend you the money, you build your own terms, and it can be a private investor, it can be a family member who wants to invest their money, but somebody privately gives you the funds to fund this deal. And then the most common way with fix and flips is hard money loans. Hard money lenders, they don't look at credit. They don't run a credit report or look at your income or anything like that. They look at the deal itself. If it's proven to be a good deal, a hard money lender will loan you a percentage of the deal up front and typically cover the purchase price and the renovation costs. Each hard money lender is going to be different, so you have to reach out to some in your area. But majority of the time, they will lend you the purchase price plus the renovation costs, and then they typically get paid out at closing whenever you sell the property. So hard money loans are designed for fix and flip styles. Now, hard money, it is a short-term loan. There's typically no limit on how quick you can pay off that loan. But the main caveat with hard money loans is that there is a monthly payment and it's interest only. So you typically get a higher interest rate with a hard money loan. And when you make monthly payments, it's not going towards your principal balance. You're only paying interest. And so hard money loans are designed for fix and flips, but they profit the most whenever the deal takes longer to sell. So they can be expensive, but here's the key. If you can be fast, then they're effective. If you can get the deal done and flipped very quickly, you'll limit the amount of holding costs that you have with this loan. But if it takes you a while to sell the property, or if it takes you a little bit longer to do the renovation, all you're doing is paying interest for holding that property. And so that cost can eat directly into your profit if it's taking longer than the amount that you have it budgeted for. So it's very important that you know exactly what the hard money lender is going to cost you, and then have the strict timeline on the deal being done. And then, of course, one of the key factors that determines how quick a deal can get done is the renovation process. So the renovation process is where execution matters. All of your homework that you do up front, all the quotes that you get before you close, all of that is now put into play, and all your homework that you did beforehand is now paying off because this is where you execute on that plan. So before you close, you want to get a clear scope of work. That's why those three categories are important. Are you doing a full gut or just cosmetic? So you want to have that scope of work before you close. You want to know exactly what you're fixing, what you're upgrading, and what the budget is. You want to get multiple bids from a few different general contractors. It's very important that if you're investing in your local market, you have a general contractor that you can trust, either one that you've worked with in the past or one who specifically works on deals like this that can get the job done quickly and that fits within your budget. So you want to either build this relationship over time with a good contractor or use a good referral, because this can be a very dangerous part of the system. You're trusting this person with the most important part of the flip, and you're paying a lot of money for it. So get multiple bids, get referrals for the contractor so that you know that you can trust them. Don't just rely on one. If you can get bids before you close, that would be even more helpful, because that'll directly impact your purchase price. Get their bid, and then you want to add miscellaneous or emergency funds. So take whatever number that they give you and then add 10 to 20%, or add $10,000, whatever that number is for your market. You need to add a miscellaneous fund just to the top of their quote, because it's inevitable almost every time something unexpected will come up. They will take the shower out and see the plumbing is awful beneath the shower, or you'll gut the kitchen only to find more problems behind there. It never fails. You need to have the quoted bid from the contractor, and then you need to have your own personal kind of emergency fund or miscellaneous fund for unexpected repairs to come up. There are some very common mistakes in underestimating costs, hiring the cheapest contractor, changing the time frame and plan mid-project. All of those items can be mistakes along this step of the process. So I would, if anything, you want to overestimate the cost, because anything you overestimate and it comes under budget, that just cleared up room for those unexpected costs or for profit. So it's very important that instead of underestimate, you overestimate slightly. You don't want to hire the cheapest contractor because they could have left something out of the bid. Their work can also be a little less quality than the others that you had the potential to go with, or they could have just missed the mark. They quoted you incorrectly, or something happened, and then it's going to end up costing you money later. So the cheapest is not always the best to go with. It's important that you analyze each quote, each bid, and make sure that they are all the same and that everything's included. And then you want to have a good timeline. You don't want the plan or timeline to change mid-renovation, because any longer that this takes, it starts to add up very quickly and it's costing you more money. So it's important that you have that dated time so that you can get the deal done and not into your profit. Let's go into the holding costs that are associated with a fix and flip, and then that timeline. Timeline is one of the biggest risks, because the longer it takes, the more money it costs you. I personally did a fix and flip right as interest rates were on the rise. And so a deal that should have only taken us 3 months to get done and get sold ended up taking us 6 months. So that was about $10,000 worth of cost that we didn't expect to have, just because it took us that much longer to sell the house. I'm not telling you all of this, I'm not pulling this information out of my butt. We've lived it. We've been there. I'm speaking from experience that this has happened. This happens time and time again to real estate investors. So timing is one of the biggest factors in fix and flip. So every day that you hold the property, it costs you money. You're paying the interest on the loan. Every month you'll have a payment that you'll be paying, and it accrues daily. You're also paying property taxes. You have to pay the property taxes for the amount of time that you are the owner of this property. You have to hold insurance on the property. And so the longer that you have the house, the longer you have to pay insurance. And so the quicker you can get the deal done, the better. And then one last one that people typically forget about is the utilities. You are holding utilities during this entire process. So if you're listing the house in winter or in summer, we all know those utility bills can get up there quite quickly. And so it's very important that you factor all of these into your holding costs and mitigate your timeline so all of these are reduced as much as possible. The typical flip might take 60 to 90 days. That is most people's goal. 60 to 90 days is the average amount of time for you to actually get the home flipped and get it onto the market. You probably want to speak with a realtor to see what your average days on market to sell a home is, and factor that in as well. Because although you completed the renovation and listed on the market, that doesn't mean it's going to sell on day one. So we need to know that amount of time that it may be sitting on the market and factor that in as well. So typically 90 to 150 days to actually fully complete the entire process is best to budget for. Keep in mind, it's always best to budget for longer or over budget. And then if it happens sooner, if you get everything done quicker, it's only profit from there. It's only good, only green from there. So you want to factor all of that in. The larger the scope of work, the longer that timeline needs to be. You need to budget for longer, because keep in mind, if you're doing a more major renovation, contractors have to pull permits, inspections might need to be done, and those people, they're not on the same clock you are. Inspectors will come out, city inspectors will come out, they're next available. They're not going to be there the next day. They are not running a tight ship like you are all the time. So delays can happen. You want to factor all of that in at the beginning if you can. So you want to budget correctly, but delays can happen. You want to try and mitigate them as much as you can, because every delay will eat into your profit. And so, really time kills the deal. The longer you hold it, the less profit that you can expect to see after it's all said and done. And then once the renovation is completely done, you have to sell it. You don't get that profit until it's somebody else's property, and you get paid out until it's actually somebody else's property, and then you get that check in the mail. So it's very important that if you are a realtor yourself, you might check out episode 10 of the podcast, because it's best listing practices. But if not, you need to find a good realtor, a good real estate agent in the area who helped you price it correctly, who knows your plan, and who can get the job done quickly. It's very important. You'll need good professional photos, a good pricing strategy, which they should have been talking to you about already. It needs to be clean or staged pretty effectively, and then they got to be a good marketer. They've got to market your property correctly, because if all those things don't happen together, the house is going to sit. And there's nothing worse. There is nothing worse than a completely renovated house sitting empty for 3 months because you can't find a buyer. It sucks, because there's nothing else you can do. You're not waiting on anything else. You're just waiting for that buyer to come along. So this is still an important part of the process. This is also why pricing it from the very beginning is very important, because once you're on the market, if there's no buyers coming along, the only way to stir up interest again is to lower the price. And every time you lower that price, it's eating into your profit. And so it's very important to even think about this step months beforehand when you're purchasing the property. And again, the longer this property sits, the more it's going to cost you. However, once the deal gets done, once you do sell the property, this is when you can sit back and relax. This is when you can celebrate. What will happen whenever you close on the house is the title company will pay out the hard money lender, or whoever lended you money. They will get paid out. You can pay all invoices or any other open bills for the renovation process, and then everything that you're left with afterwards is pure profit in your pocket, baby. Isn't that the best feeling ever? So it's great. Again, fix and flips is an incredible way to make cash in real estate semi-quickly, but there are some risks. Obviously, if you don't have any money left over, no profit. If you have to come out of pocket to pay holding costs and stuff like that, no profit, right? And so you can kind of see how it's a slippery slope from going from one of the best ways to make cash in real estate to the number one way to lose cash in real estate, right? So it's a very slippery slope that can happen very quickly. Let's go through a few risks and then a few areas where investors typically make mistakes so that you can avoid them yourself. Some of the biggest mistakes are overpaying for the property, not getting the best deal possible right at the very front. If you overpay, your numbers are completely thrown off, and it constrains you to the rest of the process. Underestimating repairs. I know a renovation budget, can range from $50,000 to $75,000, and that sounds like a lot to renovate a house, but you would so much rather overestimate than underestimate. Underestimating repairs is probably the number one way that investors fail, because they think, oh, we can get this done so much cheaper, or I can come in and do some of the work myself, or they don't have that emergency fund saved for miscellaneous repairs, right? They don't have any of that. And so something comes up, the plumbing system has to be replaced or the roof has to be replaced, and they didn't calculate that in. So it's very important that you don't underestimate repairs. Poor contractor management is a big mistake as well. So you hired the cheapest labor, you gave them $20,000, and now you can't get a hold of them, right? That's a scary feeling right there. So it's very important that, one, you choose a contractor that you know very well, whose terms might be a little bit less than giving 50% up front or something like that, who's okay with getting paid in stages as the work is completed, and one that you're going to be able to get a hold of fairly easily and make sure that the timeline is progressing as planned. A contractor who gives you a dated timeline like that, perfect. During the project, like I mentioned before, so you still want to keep a foot into the market and see what's going on. If you buy a flip and use numbers from summertime, and then you go to list it in the middle of winter, your numbers are going to change. You have to factor that in as well. Best time to buy a flip is at the end of the year or in winter, and then plan to list it during the summertime, peak season. And so if you do that opposite, it could end up costing you a little bit of money. And then, like with every investment strategy, emotional decision making. If you make a decision based on your emotions, 99% of the time in real estate, it goes wrong. So that goes with purchasing the property. If you purchase a house because it's in the neighborhood that you used to live in and you just so bad want to make this place look good, it's going to bite you in the butt. Or if during the renovation process you make an emotional decision and you want to paint this wall light blue because you just had a baby boy and he would love that, or whatever it is, I mean, it's an emotional decision. You need to cater to the general public because this is a business. It's not your house. It's not meant to be your house. Everything needs to be made with a business decision, chasing after that profit. Do not gamble with your profit. You want to make business decisions and set yourself up for success whenever you go to sell the property. And who should be flipping? Who should be doing this, right? Our listeners range from people who are brand new and barely getting into real estate to landlords who just decided to rent out their previous house they lived in, all the way to professional real estate investors. And so, in my opinion, who should be doing fix and flips and who should not? So I think fix and flips are great for hands-on investors, people who can watch over this project over the next 3 to 4 months and make sure that it gets done. People with capital reserves. So you have a few savings accounts, you're ready to invest, and if you were to lose $5,000 on this deal, it wouldn't completely bankrupt you, like it wouldn't change your life. People with capital reserves are the ones that want to get into fix and flips because, like I said, it can sometimes be a slippery slope on having to pay money out of pocket. And then people who are comfortable managing projects. Just because you get into this and hire a general contractor doesn't mean the whole thing is going to happen automatically. You are the one who is basically going to be managing this entire project until the very end. So it's very important that you have the time to do it and that you're the type of person who is good with managing those type of projects. It's very important. So if that sounds like you, by all means, jump into it, get after it, and go make you some money. Now, fix and flips, they are not great for first-time investors with no margin for error. If you're a first-time investor, real estate is a foreign concept for you. Half of what I talked about in this podcast doesn't make any sense. Fix and flips is probably not the place that you want to start because there is just a lot of room to make a lot of mistakes. And every mistake, it's not a little, oh, let me get out of this. Let me cancel the contract and I'll get out of this. It's every mistake can cost you thousands of dollars. So first-time investors with no margin for error, it's not for you. People relying on perfect outcomes, this is not for you. So like I said, if you need the stars to align to get your after repair value, it's not for you. If you are hoping and praying that the stars align so that this deal gets done, I wouldn't do it because that means you're hoping for something else to happen instead of making it happen yourself. You need to be the person who does their homework and calculates what it's going to cost, puts it into play, and then gets the deal done. If you're relying on other people's outcomes, it's not just going to come perfectly. If that was the case, everybody would be doing it. And then third, people who don't understand construction. If you don't have a foot in with construction or have done rehabs before or something like that, I might stay away from this end of it because you have to know a little bit about construction to make sure that you're not getting screwed over. Just flat out. You want to make sure that you're not getting screwed over, you're not getting taken advantage of, and that you're not paying this person thousands and thousands of dollars to renovate a house and they not do a good job. So it's very important. So if you are a first-time investor, maybe with no margin for error or no cash in the bank, I'd stay away from fix and flips. If you're relying on others to make sure that this deal gets done, I'd stay away from it. And then if you have never understood construction very well, I'd stay away from fix and flips as well. Now, obviously, as we've seen on HGTV, as we've seen on TikTok and YouTube, fix and flips can be a strategy that makes people a lot of money, but you've got to be the right person. You've got to be the right person for the job, and you've got to know how to analyze the deals correctly, execute on your plan, and then sell it effectively. If you can do that, if you're this type of person, fix and flips can be extremely profitable. You can make a bunch of money off of it, but you got to buy right. You've got to run your numbers correctly, and you've got to control the costs so that when you sell, cash in, ka-ching. Profit through the roof. If you're thinking about flipping a property and you want some help on how to gather renovation costs, who to start connecting with on looking at purchasing a property, all of that, feel free to reach out to us at First Choice Property Management. You can head over to our website at fortworthpropertymanagement.com. You can always shoot me an email or a text or something like that. And then we appreciate you so much for sticking around and listening to these podcasts. I know fix and flips and investing is not always for everyone. And so we're very thankful for all of our listeners. If you stuck around to the end of this episode and are listening right now, leave us a 5-star review on whatever platform that you're listening to, or comment below the word rental. And the first person who does that will get free Omaha steaks sent to their front door as a thank you for being an avid listener of the Fort Worth Property Management Podcast. Comment rental below this podcast or leave us a 5-star review, and I will personally reach out and make sure that we get that over to you. If you need any of the equations that we spoke about today, if you need a fix and flip calculator or something like that, shoot me a message and I'm happy to point you in the right direction. That will conclude our episode 11 here. This is part 2 of our investment strategies, fix and flips. Thank you so much for tuning in today. We appreciate each and every one of you. I am Mason with First Choice Property Management. We are super excited to see you in the next episode. Have a good rest of your day.